Hello, my name is Miad and welcome to the Forex and Bond Market Crash Course. I'll be talking you through what bonds are, bond deals and the correlation with Forex, and also point out the huge divergences that sometimes appear in the mispricing and opens up a gap to make massive trades. The bond market is one of the main engines of the Forex market, as foreign investors invest in different countries and they move money about to do so and buy foreign bonds. The US bond market is $40 trillion big, so it's a lot of money to be involved in, and something you want to follow on a daily basis to understand exactly where the spot rates are moving in the Forex market. The correlation between the bond and the yield of that bond is inverse. So if the bond prices would pick up, the yield of that bond drops in value. And that's the same across every maturity. So the probably most popular bond yield maturities are 2-year, 5-year and 10-year that we tend to track quite closely. Which means that every time that the bond price goes up, the yield of it will go down. There is a close correlation between the yield of that bond and the currency of that particular country. So if I'm looking at the US 10-year yield chart and it is rallying for month end, it's very likely that the US dollar will rally with it as well. So there's a close correlation between the bond yield of that country and the currency of that country as well. That's the basic of it. The current chart you're looking at is actually the US 10-year yield chart on a weekly. I've opened this on TradingView. You can find bond yields of different countries, probably on most charting packages or news apps. It's quite an important thing in the market. What I want to go through with, I don't want to talk too much into the details of how bonds work, what the maturities are, the different types of bonds, and why investors buy and sell them. I like to keep it limited to really the technical features to save you a little bit of the background work and just really try to capture the meat of that. What I'm looking at when I look at bonds is, of course, well, I have them the bond yields, is to see if they've been rising, if they've been falling, what are the reasons behind it. Is a negative news? Is the central bank of that country raising interest rates? Are they cutting interest rates? That always reflects into bond yields as well. That's something I always keep an eye on. But to keep things technical and easier to digest, what I will demonstrate now is the correlation between the bond yields, different bond yields, and the different spot rates in the Forex, so you can see the differences. To bring up a bond yield chart, you just need to type up US 10 and add an Y in the end of it, and it shows you the bond yield chart for the United States. For the European bond yield, because Europe is made of many countries, I usually take the German bond yield, which is DE10Y, as a gauge for the euro. For Britain, it is GB10Y, which represents the gilt yields. For Canada, it's CA10Y. I'm just going to really quick talk you through all of them and quickly show you the charts as well. For Australia, it's AU10Y. New Zealand, that is NZ. For Japan, it's JP10Y. And that takes us from most of the core currency pairs we usually look at and trade, either through the majors or if we do trade crosses as well. I'm gonna go back to the US 10-year yield chart and show you the comparison to the German ones as well. So when you type in a hyphen next to the bond yield, what you can do is create a new chart. So I'm looking to do that. I'm looking to see the chart of the German 10-year yields over the American or United States 10-year yields, and I want to see the fluctuations over the years and also compare that to the comparable Forex spot rate, which would then be Euro USD. I simply overlay that, so click on compare and add Euro USD as overlay chart. In essence, what I've done is I've created a chart to see which yield of that country is stronger or weaker. So you can see probably for 2016 the German yields were weaker against the United States, then it picked up again, and then it crashed down somewhere between end of 2017 until recently. And the spot rate tends to follow suit with the yield charts plotted against another. And there's also terminology for it. When you plot one yield against another yield from another country, we call it a bond spread, a bond yield spread. The German and the United States one is very popular, and it's called Bond-Bund spread because German bonds are called bunds. Without getting again too much into detail of that, you can see major swings were all sort of in tandem. So your Forex spot rate, which is the orange one, that's the Euro USD, on a weekly chart, was quite most of the times in tandem with the yield spreads as well, until quite fascinatingly in 2017 and around October they kind of broke away, if you can see that here. So the bond spread sort of stabilized on the bottoms. Euro USD started to travel higher towards the end of the year, but the yield spread kept pointing lower and crashed down. There was a massive divergence. So I'm going to zoom that in on the daily chart so you can see that a bit close up. It caught a lot of analysts back in the day off guard because they were constantly putting out analysis that Euro USD will move lower based on the bond yields, which obviously made sense, but they failed to see that there was a divergence establishing. I'm not going to go into the details why that divergence happened. I'm actually going to zone that out so you can spot that easier. So from around, again, in November, end of October, November, they started to diverge until mid-April in 2018, I believe. So there was a big divergence there. Euro USD rallied quite strongly during that time. I believe it was about a 700 pip move, more or less. And all the time the spread was pointing that prices should come lower. There was a couple of dynamics, the reason it stood up there, and that again involves reading the news, understanding what was behind it, the speculators that were long, and the growth and the bullish growth trap they were getting caught into, and it didn't release the longs until later in April in 2018. However, the entire time you would have spotted this massive divergence. That's a bubble, and that's what I'm trying to teach you through this video, to spot bubbles in the FX and yield spread charts. So you can obviously see here from month end there was leading lower. Euro USD was moving nowhere, just 200 pip move up or down, and it was caught in that box until it literally broke out and just crashed out. Massive 800, I believe 1100 pound move if you count up until now, and then started to converge with the yield spread chart again. And this is really where the magic of the yield spread divergence with the Forex market lies, where the yield spread leads the way, spot Forex is hanging behind for whatever reason, and when it catches down, it does so usually very rapidly. So to quickly recap what we're looking to do, we try to create a yield spread chart and then compare it with the comparable FX spot market. In this case it was the bond spread, and then we overlaid it with the Euro USD, and there was a massive divergence there. I'm going to show you a little bit more recent play from January this year. There was on Euro GBP. I beg your pardon, I'm going to type in the yield spread chart first. So that is DE10Y against the pound, or the UK bond yield at GB10Y. Overlay that with the Euro GBP chart. There again was a massive bubble where the yield spread chart was leading lower, but FX wasn't quite moving yet, and it opened an opportunity to exploit that and short ahead of it before prices converged again and catch down with its own value. The trade was around, I believe, end of or middle of January. We found ourselves at that sort of ceiling back then when I started shorting Euro GBP. Again, the yellow lines, orange actually, represents Euro GBP. The candlestick chart is the yield spread. Yield spread was pointing lower for 1 or 2 weeks actually, but Euro GBP didn't quite catch down. Back then my analysis I was quite confident that the yields will not pick up so quickly again. Either way, there was massive mispricing, sort of bubble if you may. Great idea to short into it, and eventually did catch down quite aggressively again, like in that other example I showed you earlier. Another example I will show you is the New Zealand yields against the US yields. That was quite recently as well, where yield spread was showing the prices are about to come down. Sorry, yield spread chart was showing that the value is sitting much lower, but the spot market did not pick up on it until much later. So again, the orange line here is the Kiwi or NZD USD. The candlestick chart is the New Zealand yields over the United States yields, and from about, I believe it was around March, it started to move aggressively lower, and there was an opening in by the end of March where Kiwi was trading at the ceiling of its own range on the spot FX market, but the yield spread was pointing at much lower values. It felt like since middle of January, Kiwi was doing its own thing without really paying attention that the real value probably lies a bit lower, and it did in the end catch down again, and I believe it's got another leg lower to do so. So to this point, I hope it makes sense that when there's a bubble between the yield spread chart and the FX spot rate, then there's always an opening to see those converge again, and that usually is between 2-3% move. And in an FX market, depending which currency pair you're looking at, that's sometimes 200-300, 500-600 pips. It's quite lucrative to keep these in mind. What you're looking to do in this method is that you're looking for divergence, really basic higher highs on one and then lower lows on another, and looking for a divergence, ideally at the cheapest level where you can sell it or buy it, depending on where the value lies. I'm also going to show you a couple of other tricks where you can do with the bond yields on a daily basis. There is the British pound is extremely sensitive to its own yield, and you don't even need to create a yield spread chart, because, and I'm going to show you why, the 2-year bond yield is trading in a very particular range recently, and continue to do so since last year, because the Bank of England was hold, and they said that they're not going to raise interest rates or lower them for quite some time because there's a bit of uncertainty because of Brexit. and that meant, so I'm just going to prepare this chart here, that meant that the 2-year yield was trading in a very predictable sort of range. And it also meant that whenever it was in a lower range, it would move up again. If it was moving a little bit, deviate a bit too far above, it would catch down. Interestingly, cable or GBP USD is very, very sensitive to its 2-year yield chart. You find that other currencies are as well, but not as sensitive as probably the pound is, or particularly cable to its own yield chart. A quick explanation what all these lines are. So you see my sort of this gray zone or blue zone beneath and above. That's sort of, I've marked out the extremes, but what's more important to me is that orange horizontal line. It shows you 0.75%. That is the current interest rate of the United Kingdom or of the Bank of England, and that is not set to change, which also means whenever price moves too far away from it, I should expect it to snap back in there. Interestingly, that also means that when GBP USD moves a bit too far away, it does tend to catch down with it. I'm going to show you how that looks like on the chart. I'm actually going to scale down right into intraday moves, because I know that that's quite popular to trade cable intraday. It's very lucrative because you can see these openings happening left and right. So I'm going to show you a couple of examples where, if you were in a cable trade, you could have either maximized your profit potential, would have got in earlier, or you would have closed out because the move higher was not really making any sense based on the yields. So what I'm usually looking to do with the yield charts, when I look at the yield charts, I'm looking for the value, isn't it? So if the yield chart is telling me that it's moving lower, that probably means that the value of the particular currency is lying lower as well. And in essence, your yield chart is sort of a crystal ball telling you where value lies. That helps you a lot of things. That means that sometimes when the technical analysis shows you that there's a first profit target at, I don't know, at 80 pips, but there's also a Fibonacci extension showing you can take 200, 300 pips. And then you look at your yield chart and you think, no, 200 pips really does not make any sense. There's not any value, because the yields will probably have to come down before that. And it also means instead of you closing partial of your profits, you're going to close it all out, because you're quite certain that there's not a lot of value to move any further, and that keeps your margin open to engage into other trades. I have picked so I picked the hourly chart on the 2-year bond yields of the United Kingdom and plotted it against GBP USD or cable and the orange lines. And I'm looking for these massive divergent moves where the yields moved one way, spot FX moved another, or kind of stood stagnant. That's a particular example here where you found that the yield it's moved so dramatically lower, but sort of spot kind of moved lower with it, moved up and sort of consolidating. If you were in a market and you weren't unsure if you should buy and sell, you just would look at your yields and it would be an obvious sell, because your yields are telling you that the value of that particular FX spot is probably not where it is. It should be sitting much lower in regards to the yield chart. So we have been seeking to engage into probably sell scenarios. There's also a couple of ways where you can gauge if you want to buy or sell or exit it. When you're, again, that works really well with pound and the 2-year bond yields. When the bond yields is approaching its sort of midpoint of 75, or its value point of 75%, sorry, not 0.75%, you are probably looking to get out of a trade. And when it's deviating too far above it, or even if it's sitting too low underneath that level, you're looking to probably buy it to move towards it again. And there's loads of intraday sort of levels where you can find these things happen. I even scroll back for you here in the sort of past, where every time pretty much the 2-year yield was sort of trading way underneath it. You found that the pound was sort of moving higher. Every time you had a good dip from the 2-year yield into the sort of the extremes of its own zones, you found that pound always found another leg higher, was a good reason to buy it. That helps you a lot of times to gauge breakouts as well. So if you were active in the market around the 7th of December, for instance, pound took out its own lows and just kept on coming lower until somewhere settled, I believe, around it was the 25 level. If you looked at your yield chart at that point and you weren't sure if you should buy and sell, knowing that there was no interest rate cuts coming from Bank of England, you'd be probably looking to long this thing because there was value in it. It was trading out of range, and it would want to converge towards 75 point again. That would have meant for you at least 300-400 pips on a couple of days moves. So there's a lot of these bubbles you're looking to find on an intraday basis, and plot your technicals to get the cheapest price into a trade, but also gauge then when a breakout is real, or if maybe price moved too far, that maybe it's time to take profit based on where your yields are sitting. Last one I wanted to show you is the yen. Yen is one of the very rare currencies that does not move in correlation with its own yield. So the Japanese 10-year yields, if they go down, yen doesn't go down with it. Yen actually moves up. Let me show you what it looks like on the charts. I'm gonna overlay the just the 10-year Japanese yield with the yen. So USD JPY. Again, it moves in. USD JPY would then move in correlation, sort of, with the Japanese 10-year yield. Let me just scroll down to quite a bit more recently. I've got these lines drawn out because that's sort of the band of extremes where the Bank of Japan says they will tolerate for the Japanese 10-year yield to move. So if price approaches those extremes, again, good idea to buy and sell. Just to quite show you how close the correlations are, even on an intraday basis. Maybe even the 4 hourly, that's a bit more realistic for the Japanese yields. You find that they do quite close in tandem. So again, the candlestick chart is the 10-year Japanese yield, and the orange overlay is USD JPY. In that essence, that yen is different than other currencies and doesn't move in correlation. It's in counter correlation to its own yield. Just in case when you were overlaying your chart later on and doing your back test, keep in mind that yen is the other way around. One of the rare currencies that does it because of its nature of being a funding currency. Well, that's all from me. Thanks very much. It's a lot of information to take into the very first time. Try to let it sip in. Use it throughout the day. Have a look at your yield charts, how they move, and on a weekly basis, when you do your sort of overviews, have a look at where the yield spreads are lying across all the charts as well, to give you an opening to get into bigger trades. Thanks very much.